Gold crossed $5,000 an ounce, quietly. No emergency Fed meeting, no global market shutdown, no sudden geopolitical shock. Just a Monday morning in Asian trading, and suddenly spot gold is printing $5,040. Silver is pushing $80, and most people scroll past it like it's just another number. But this part matters more than it looks. Because gold doesn't casually cross psychological levels like this, especially not after a violent pullback the week before, and especially not when the US dollar is still firm and real yields are elevated. So the first question isn't, is $5,200 next? The real question is, why didn't gold break down? Let's slow this down. I've been watching gold markets for a long time. Long enough to know that when prices do something unexpectedly calm after volatility, it usually means something structural is happening underneath. And this move, above $5,000, didn't come from hype traders or social media narratives. It came from policy signals, currency pressure, and positioning resets. Here's what actually happened. On Monday, February 9th, after one of the most volatile weeks we've seen in months, gold rebounded nearly 1.2%. Silver moved even faster, up more than 3%, touching $79 at 89. This wasn't a continuation rally. It was a recovery from a sharp sell-off driven by profit-taking, a stronger US dollar, and rising real yields. In other words, the exact conditions that are supposed to hurt gold. And yet, gold held. Now, here's what most people missed. The catalyst wasn't the US. It wasn't inflation data. It wasn't even the Fed. It was Japan. Over the weekend, Japan's incumbent Prime Minister Sanae Takaichi secured a decisive election victory. Markets immediately interpreted this as a green light for continued accommodative fiscal policy and ongoing pressure on the yen. And when the yen weakens, something important happens. Gold doesn't just rise because people are scared. It rises because currencies lose credibility relative to hard assets. A weaker yen reinforces the idea that major economies are still choosing stimulus over discipline. And that matters to global capital allocators, especially central banks. According to the data cited in the article, longer-term gold demand remains supported by continued central bank purchases, limited mine supply, and currency diversification. This isn't speculative money. This is slow institutional repositioning. And that's why this rebound looks different. Last week's sell-off wasn't panic selling. It was leverage being flushed out. Excess positions built during January's rally were unwound. That matters, because markets don't trend sustainably when they're over-leveraged. Corrections like this reset the system. And when gold stabilizes after leverage is removed, that's when levels start to matter. Right now, according to market participants, $4,800 to $4,900 has become the key zone. Gold pulled back from record highs, tested that region, and held. Not once, repeatedly. That range isn't random. It lines up with the previous breakout area and the lower boundary of a multi-year rising channel. In plain terms, it's where long-term buyers are comfortable stepping in. As long as that level holds, this move above $5,000 isn't a blow-off top. It looks more like consolidation at altitude. Now contrast that with silver. Silver had already corrected aggressively from highs above $120 earlier. It's volatile. It always is. But notice where it stabilized. $71, $80. That's not speculative air. That's structural demand, industrial and monetary. Silver isn't just a store of value. It's embedded in energy systems, electronics, and industrial supply chains. And here's the technical detail that matters without getting lost in jargon. A hammer formation formed near $64, aligning with the long-term 100-day exponential moving average. That's a classic sign of buyers defending a level. Again, after leverage is flushed, so both metals corrected. Both found buyers. Both rebounded, not explosively, but decisively. Now zoom out. At the same time this is happening, markets are waiting for U.S. economic data. A January employment report expected to show a stabilizing labor market. Inflation data coming later in the week. Notice the wording. Not overheating, not collapsing. Stabilizing? That's uncomfortable territory for central banks. Because stabilization doesn't give the Fed a clear reason to cut aggressively, but it also doesn't justify tightening further. That limbo is where gold tends to do well. And that's why this moment is unusual. Gold is holding above $5,000 before policy clarity, not after. Historically, big gold breakouts happen when something breaks. Financial stress, currency crises, emergency cuts. This time, gold is acting like it's front-running something instead. Now, does that mean $5,200 is guaranteed? No, and anyone telling you that is selling certainty they don't have. What it does mean is this. The market is treating $5,000 less like a ceiling and more like a checkpoint. And checkpoints matter because they change behavior. Above them, sellers hesitate. Below them, buyers defend. According to analysts cited in the article, as long as $4,800 holds, This phase is viewed as a corrective pause, not a trend reversal. And if safe haven demand returns, or if the dollar weakens even modestly, the path toward $50, $200 reopens. Not immediately, not linearly, but structurally. And that raises a deeper question. If gold can hold these levels without a crisis, what happens when one shows up? Because that's the part nobody's comfortable answering yet. Gold isn't reacting to fear headlines right now. It's reacting to policy signals, currency pressure, and long-term accumulation, which suggests this move might not be about panic at all. It might be about preparation. And in part 2, we need to look under the surface at the mechanisms most investors never see, the macro linkages quietly aligning, and the risks that could turn this consolidation into something much larger. Because if $5,000 isn't the top, then the real story hasn't even started yet. Now, let's go beneath the headline. Because price alone doesn't tell you why something is holding. And in markets like gold, the why always matters more than the number. What we're seeing here isn't a speculative surge, it's a structural response to how the global system is behaving right now. And to understand that, we need to talk about mechanisms, not predictions. Let's start with the quiet driver underneath almost every gold move. Real yields. Gold doesn't compete with stocks. It doesn't compete with crypto. It competes with real returns on money. Last week, real yields rose. The dollar strengthened. That combination usually pressures gold hard. And it did, for a moment. But then something important happened. Gold stopped responding the way it used to. Instead of cascading lower, it stabilized above $4,800. That tells us the marginal seller dried up. When that happens, it usually means one of two things. Either weak hands are already gone, or stronger hands are absorbing supply without urgency. The article points clearly toward the second. Central banks continue to buy, mine supply remains constrained, and currency diversification isn't slowing, it's accelerating. That last part is key. This isn't about one country or one election. Japan's result mattered not because of politics, but because it reinforced a global pattern. Major economies are choosing managed debasement over disorderly tightening. Pressure on the yen is tolerated. Pressure on balance sheets is deferred. Fiscal accommodation remains the default. Gold doesn't need chaos to rise in that environment. It just needs consistency. Now layer silver into this picture. Silver is often misunderstood because it wears two hats, part monetary metal, part industrial input. That dual role makes it volatile, but also revealing. When silver collapses, it usually signals demand stress. When it stabilizes while gold holds, it suggests something different. Industrial demand isn't breaking, and monetary demand isn't leaving. The article notes silver stabilizing between $71 and $80 after correcting from much higher levels. That's not speculative froth, that's recalibration. The hammer formation near $64, aligned with the 100-day EMA, is technical confirmation, but the story is broader. Silver is being repriced in a world where energy transition, electrification, and supply constraints aren't theoretical anymore. That doesn't guarantee upside, but it limits downside. Now, zoom back to the US data everyone is waiting for. Employment, inflation. Markets are hoping for just right numbers. Not too hot, not too cold. But here's the uncomfortable reality. Stabilizing data traps central banks. If inflation doesn't fall fast enough, rate cuts get delayed. If growth doesn't collapse, easing lacks urgency. That's when policy credibility erodes. Not dramatically, but gradually. Gold doesn't spike on that. It grinds higher. And that's what makes this moment tricky for investors. There's no clear signal to chase. No crash to react to. No obvious narrative to anchor on. Which is why many people are asking the wrong question. They're asking, is this the last chance before $200? That frames the move as a sprint. What the market is behaving like is a slow relocation of value. Now let's talk risk, but properly. There are multiple paths forward from here, and none of them are certainties. One path is continuation without drama. Gold consolidates between $4,900 and $5,100. Volatility compresses. Silver chops sideways. That would frustrate both bulls and bears, and quietly reinforce the idea that these levels are being accepted. Another path is macro confirmation. If upcoming US data shows cooling inflation without labor stress, the dollar could soften modestly, not collapse, just weaken enough. In that scenario, gold doesn't need fear. It simply needs permission. That's when $5, $200 becomes plausible, not inevitable, but reachable. Then there's the risk path, a reacceleration in inflation, or a surprise tightening signal, or an exogenous shock that pushes real yields higher again. In that case, $4,800 gets tested hard. And this is important. If $4,800 breaks decisively, the narrative changes. Not permanently, but meaningfully. That's why analysts in the article emphasize that level so strongly. It's not magic, it's memory. Markets remember where conviction last showed up. Now, step back even further. What does it mean when gold trades above $5,000 before a global recession? before emergency cuts, before credit events. It suggests gold is no longer just insurance. It's becoming a reserve alternative in real time, not replacing currencies, but hedging their trajectory. And that's why this move feels different from past cycles. In previous decades, gold surged after policy failure. This time, it's responding to policy persistence. That doesn't mean the system is collapsing. It means the system is choosing predictability over reset. For long-term holders, that distinction matters, because gold doesn't require you to believe in disaster. It only requires you to acknowledge incentives. And right now, incentives favor gradual debasement over sudden austerity, stability optics over structural reform, liquidity management over monetary purity, gold prices that behavior, not headlines. So where does that leave us? Not with a call to action, not with certainty, but with clarity. $5,000 wasn't a fluke. It wasn't a panic spike, and it wasn't rejected. It was tested and accepted, at least for now. Whether this turns into a sustained move higher or prolonged consolidation depends on forces that haven't fully revealed themselves yet. Policy signals, currency responses, and how much risk the system can absorb without something cracking. And that's why this isn't the end of the story. It's a checkpoint. And the real question going forward isn't how high gold can go. It's how comfortable markets are living at these levels before something forces the next decision.